Welcome back to the deep dive. So, you look at a huge company's annual report, right? Billions in revenue. You'd probably guess they just added up all the numbers from their subsidiary companies. But if you're actually trying to figure out how they're doing or calculate a ratio, well, simple addition. It just doesn't work. Today, we're diving deep into something called corporate consolidation, specifically the Consolidated Statement of Profit or Loss, or CSPL. Our mission, using the sources you sent in, is to really unpack why this whole process isn't just basic math. It's more like forensic accounting. Yeah, stripping away all the internal stuff to show the group's real performance, as if it were just one single company.
That's a great way to put it. It's all about getting to the economic truth. The starting point is, well, you combine the parent company's income and expenses with all of the subsidiaries' income and expenses, top to bottom, so you get this big combined picture. But the real trick is down at the net profit line. We absolutely have to make sure that profit is split correctly between the parent shareholders who own most of it and anyone else who owns a piece. We call that the non-controlling interest, or NCI.
Okay, NCI. That sounds like the first big hurdle right there. So if a parent, let's call him P, owns, say, 75% of a subsidiary, S,
Yep.
then the other 25% is owned by these NCI shareholders, right?
Exactly.
So it seems easy. They just get 25% of S's profit.
Well, that's where it gets tricky. You'd think so, wouldn't you? But what if S made some of that profit by selling stuff to P? From the group's perspective, has that profit really been, earned from the outside world yet?
Good point. Probably not if the goods are still sitting in P's warehouse.
Precisely. The fundamental rule here is that the NCI only gets a share of profit that's truly realized, meaning earned from transactions with parties outside the group. So this means we have to adjust or kind of filter the subsidiary's reported profit before we calculate that NCI percentage share.
Filter it. Okay, how?
Okay.
What gets filtered out?
Well, the biggest and most common thing we adjust for is something called unrealized profit, PUP for short. We'll dig into PUP properly in a bit, but the gist is, if the subsidiary sold goods to the parent at a markup, and those goods haven't been sold on externally, we have to take that markup out of the subsidiary's profit first.
Before calculating the NCI.
Before calculating the NCI share, yes.
Got it. So we're kind of protecting the NCI from sharing in profits that aren't really real yet from the group's view. What else needs to come out?
Good question. There are a few other key items. We also deduct any goodwill impairment that relates to that subsidiary if it's charged in the year. And we also have to subtract the extra depreciation charge that comes from fair value adjustments made when we first bought the subsidiary.
Fair value depreciation.
All right.
Anything else?
And also, any other sort of specific impairment losses that are relevant just to that subsidiary. So it's those four, basically. PUP, goodwill impairment, the fair value depreciation piece, and other specific impairments. You take those out of the sub's profit, then apply the NCI percentage.
Okay, that paints a clearer picture. So in that simple example you mentioned earlier, Paddle owning 75% of Skip. If Skip's profit was, say, $40,000, and let's assume for a second none of those adjustments were needed.
Right, a very clean case.
Then the NCI gets their straightforward 25%.
Right.
Which is $10,000.
Exactly. That $10K is shown as profit attributable to NCI on the consolidated statement. That's the target. But getting there usually involves navigating all those adjustments we just talked about.
Right. Now let's get into the real nitty-gritty, eliminating what you call the internal noise. This feels like where the detective work really starts.
It really is. We call it eliminating intragroup trading. Think about it. Parent sells goods to the subsidiary. Internally, P records revenue. S records a cost. Looks like business is happening. But for the group as a whole, nothing's actually gone out the door to a real customer. No external money has come in.
So it's meaningless from the outside.
Totally meaningless for the consolidated view. So we have to wipe it out. On the CSPL, you take the parent's revenue, add the subsidiary's revenue,
Okay.
and then you subtract the full value of those internal sales made between them.
Subtract the internal sale value. Got it.
And critically, you do the exact same thing for cost of sales. P's cost of sales plus S's cost of sales minus that same intragroup sales figure.
So you subtract the same amount from both revenue and cost of sales.
Yes, has to be the same amount. If you only took it off revenue, your profit would be wrong. If you only took it off cost of sales, your profit would also be wrong. It cancels out on both sides.
Makes sense. Canceling the whole internal transaction. And I guess this isn't just for goods, right? What about things like loans between group companies?
Absolutely. Same principle applies. If the parent lends money to the subsidiary and charges interest, well, that's just moving cash from one pocket to another within the group.
So the interest P receives isn't real group income.
Nope. On P's own books, it might look like investment income, And on S's books, it's a finance cost. In consolidation, both sides have to go. That example in the source material, parent loans $2 million at 10% for 6 months. That's $10,000 interest.
Oh.
That $10 income for P and $10 cost for S both get eliminated from the consolidated statement, wiped clean.
And dividends must be similar then, if the subsidiary pays a dividend up to the parent.
Classic internal cash flow. Looks like nice income for the parent company on its standalone account, but for the group, it's just shuffling retained earnings around. It's not income earned from outside. So that dividend received by the parent gets removed from the parent's investment income line during consolidation.
We only count dividends coming in from actual external investments then.
Precisely. Only external sources count as true group income.
Okay, let's spend some quality time on what you called the most notorious elimination, unrealized profit, PUP. You said it's tricky.
It often trips people up, yeah. But it's absolutely vital. Get this wrong, and you could be, well, seriously misleading people about performance. PUP happens when, say, Company A sells something to Company B within the same group. A sells it at a profit, a markup. But at the year end, Company B still has that item in its inventory. It hasn't sold it on to a real customer yet.
So A booked a profit.
A booked a profit, yes. But the group hasn't actually made that profit from the outside world. It's still tied up inside the group, sitting in B's inventory.
Right, so using that example, A buys for $60, sells to subsidiary B for $80. It records a $20 profit.
Exactly. But B still holds the item. If we just added their books together without adjusting, the group accounts would show a $20 profit already made. And importantly, the inventory on the consolidated balance sheet would be listed at $80. But the group's actual cost, the real money spent externally, was only $60.
Okay, so that's wrong on two fronts. Profit overstated and inventory overstated. How do we fix the profit bit on the CSPL?
We make an adjustment. To eliminate that $20 unrealized profit, we actually increase the consolidated cost of sales by $20.
Increased cost of sales.
Okay, why there? Because doing that reduces the consolidated gross profit by the exact $20 amount. It wipes out the premature profit. And as a neat side effect, it also brings the inventory value on the balance sheet back down to the group's true cost, the $60. Kills two birds with one stone.
Clever. Increase COS to reduce profit and correct inventory. Now, you mentioned earlier this links back to the NCI problem.
It does, critically.
You said who the seller was matters. If the parent P sells to the subsidiary S.
If P sells to S, the PUP adjustment simply reduces the overall consolidated profit, which ultimately belongs mostly to the parent shareholders anyway. It's relatively straightforward.
But what if the subsidiary sells to the parent, like in that Zebedee Xavier example?
Now that's where you have to be careful with the NCI calculation. If the subsidiary made the sale and booked the unrealized profit, then that PUP amount must be deducted from the subsidiary's individual profit figure first before you calculate the NCI share.
Why?
Because if you didn't, you'd be giving the NCI shareholders a slice of a profit that the group hasn't actually realized yet. That profit is still stuck in inventory held by the parent. The Zebedee Xavier source shows it clearly. Calculate the NCI share only after you've taken the PUP out of the subsidiary's profit. It ensures NCI only benefits from genuinely realized earnings.
Okay, that distinction, who the seller is, really clarifies the NCI impact of PUP. That's a key takeaway. Let's move on to some more advanced adjustment. Beyond inventory, what about things like selling machinery between group companies?
Yeah, transferring non-current assets, or NCAs. This can happen, sometimes legitimately, sometimes, well, maybe to make the seller's individual results look a bit better temporarily. There are two main adjustments needed here. First, just like with inventory PUP, you have to eliminate any profit or loss the selling company recorded on that internal transfer. Can't recognize profit on selling to yourself, essentially.
Okay, remove the profit on sale. But wait, the company that bought the asset, they're now depreciating it based on the higher price they paid internally, right? The price that included the seller's profit.
Exactly. You've hit the second adjustment. The buyer's depreciation charge is too high from the group's perspective. Because the group still owns the asset, that internal profit isn't truly realized all at once. It's only realized gradually as the asset is used up over its remaining life.
So how does that work on the CSPL?
In consolidation, we have to calculate how much extra depreciation the buying company is charging each year, the depreciation related just to that internal profit margin. And we reverse that extra depreciation. We reduce the consolidated depreciation charge back down to what it should be based on the asset's original cost to the group and its remaining useful life.
So reducing the depreciation expense effectively releases that internal profit back into the CSPL bit by bit over time.
Precisely. It aligns the profit recognition with the asset's actual use by the group. Very neat, but easy to miss.
Definitely sophisticated.
Right.
Shifting gears slightly, what about other expenses that might hit the CSPL, not related to PUP? Goodwill impairment came up earlier.
Right. Goodwill arises when you buy a subsidiary for more than its identifiable net assets are worth. If later on we figure out that goodwill isn't worth as much as we thought, maybe the subsidiary isn't performing as expected, we have to record an impairment charge. That impairment charge goes through the CSPL, usually as an operating expense. It reduces the consolidated profit.
And does that affect the NCI?
Yes, it does. Just like NCI shares in the subsidiary's profits, they also have to share in its losses, including a proportionate share of any goodwill impairment related to that specific subsidiary. It reduces the profit attributable to the NCI.
Fair enough. And those fair value adjustments you mentioned when calculating NCI share, how do they hit the main statement?
Good question. So, at acquisition, we might have revalued some of the subsidiary's assets upwards to their fair value, let's say a building. In the consolidated accounts, that building now has a higher value than it did on the subsidiary's own books. This means the consolidated depreciation charge on that building needs to be higher too, reflecting its fair value at acquisition. So we calculate that extra depreciation, the difference between depreciation on fair value and depreciation on the sub's original cost, and we charge it in the CSPL, usually to cost of sales or operating expenses. It ensures we match the full economic cost against revenues.
Okay, makes sense. One last big timing issue. What if the parent company buys the subsidiary partway through the financial year, not on day one?
The mid-year acquisition. Crucial point. You absolutely cannot include the subsidiary's results for the full year if you only owned it for part of the year. Consolidation accounting starts only from the date the parent gains control.
So you have to split the subsidiary's year.
Exactly. Unless there's a very good reason to believe profits are earned unevenly, like a seasonal business, you generally time a portion. You take the subsidiary's full-year revenue and expenses and prorate them based on the number of months the parent had control during the financial year.
So that example. Ethos buys Pathos on November 30th. The group's year ends March 31st.
Right, so December, January, February, March, that's 4 months of ownership in that financial year. You take Pathos's revenue for the whole year, multiply it by 412ths, and include that amount in consolidated revenue. Same logic for all its expenses, 412ths go into the consolidated statement for that period.
And the profits Pathos made before November 30th.
They belong to the pre-acquisition period. They don't form part of the group's post-acquisition profit for that year. They're treated differently, usually adjusted against goodwill or reserves.
Okay, we've really built up a comprehensive view of the consolidated statement of profit or loss, the CSPL. But that's not the absolute final word, is it? There's other comprehensive income, too.
That's right. The CSPL is really just the first section of a bigger statement, the consolidated statement of profit or loss and other comprehensive income, the CSPLOCI. Other comprehensive income, or OCI, capture certain gains and losses that don't go through the regular profit and loss account, but still affect the group's overall equity or wealth.
Like what sort of things?
Things like gains on revaluing property, like land, if you haven't sold it yet, or certain changes in the value of complex financial instruments. They bypass the main P&L, but are still part of the overall performance picture.
And I assume the NCI gets a piece of this OCI action, too.
Absolutely. Just as the NCI gets its share of the net profit for the year, it also gets allocated its proportionate share of the other comprehensive income. The bottom line of the whole CSP-LOCI statement is total comprehensive income, and the NCI needs its fair share of that total figure, reflecting their stake in the subsidiary's overall change in net assets for the period. It keeps everything consistent.
Wow. Okay, this deep dive really shows consolidation isn't just adding columns. It's this really rigorous process of achieving economic clarity. It's about seeing the whole group as if it were one single business, meticulously removing all those internal footprints, the inventory markups, the internal loans, the profit on selling assets to yourself.
That really is the core takeaway. All these complex rules for eliminations and adjustments, they're there to ensure the final consolidated reports reflect transactions only with the outside world. That's what gives them integrity. If you miss even one of these adjustments, you're distorting the true picture of the group's performance and financial position.
So what does this really mean for you, the listener, when you're looking at these reports?
Well, we've focused a lot on the rules themselves, right? How to do the eliminations. But maybe the most interesting thing is why these rules exist. Think about the potential for manipulation if these rules weren't strictly enforced. How easy could it be for a company to, say, boost its reported revenue near the year end by forcing subsidiaries to buy loads of inventory from each other at inflated prices?
Yeah, to hide weakness in actual external sales.
Exactly. Or booking a big profit by selling an old building from one subsidiary to another. The PUP adjustment, the NCA transfer rules, they're specifically designed to stop that kind of artificial inflation. So, understanding these consolidation adjustments isn't just about accounting mechanics. It helps you ask critical questions. It tells you where to look to see if a group's reported performance truly reflects its underlying economic reality. It's about spotting where the internal fiction might be trying to obscure the external facts.